I'm Dan Smolen. I built a successful executive career in marketing and communications before becoming a top headhunter and founding my own executive search firm. Now get this, every day, mainstream media runs stories in which old school bosses and thought leaders frame your work and workplace issues in ways that are often divisive and unmeaningful. And that's just crazy. The time has come for you to answer the question, what's your work fit, so that your work and career fit who you are, how you want to live, and what you want your lasting contributions to be. What's your work fit? It answers your questions and tackles the issues that keep you up at night about advancing your career in this time of workplace revolution. So let's get started. Hey, good day, everyone. Dan Smolen from What's Your Work Fit. Happy holidays to everyone. I hope you're having a good and successful day today. Eager to get our final show of the season started. But first, if you are new to our community, to our What's Your Work Fit community, thank you. We welcome you here. And if you haven't already engaged with us, please do so on the platform of your choice. We are on LinkedIn at What's Your Work Fit. Just hit that blue oval follow button. We're also at the What's Your Work Fit channel on YouTube. And if you're not already subscribing, hit that black subscribe oval and you'll never miss our future content. We also have a Substack, which you can find at dansmolen.substack.com. We update it frequently. A lot of good stuff here, live and pre-recorded shows, video clips from our live shows, our audio podcast version of the show, and our archive of pieces that we write about the future of work and workplace. Lots of good stuff here. It is a free subscription, so there's no excuse for subscribing to dansmolen.substack.com. What's Your Work Fit? We're not going to be charging for the foreseeable future. We understand that so many of you who enjoy Substack are maybe not joining up on certain Substacks because of the price. That's not an obstacle with us. So it's free. Join and be a part of that as well. One last thing, if you haven't done so already, please tell 5 friends to subscribe to What's Your Work Fit on the platform or platforms of their choice. Okay, let's get this thing rolling. It is my great pleasure to welcome back to What's Your Work Fit, Phil Mobley. How are you, Phil?
Hi, Dan. Doing great. Enjoying the nice brisk air here in Boston.
It looks like it's about 8 degrees outside behind you.
It might be as much as double that, but yeah, it's chilly.
If you are new to experiencing Phil, let me tell you about him. Phil is the National Director for Office Analytics at the CoStar Group, which is the leading provider of commercial real estate information, analytics, and online marketplaces. Very good. Okay, let's bring in our co-host here. First up, Mark Gilbreath from LiquidSpace. How are you, Mark?
Hi, guys. Good morning.
And Fran Saele from Morta Vita. Good day, Fran.
Hi, Dan and everybody. Great to be back with this crew once again.
Now, like we've done in past shows with Phil, we're about to start a masterclass. So, Phil, get us started on the U.S. office market as it is current and what it will look like in the coming year.
All right. Well, sure, Dan. I mean, I'll tell you where we've been, and we don't make predictions, but we do make forecasts. So you can debate the distinction between those if you'd like. If you want to go to the next slide, I want to show you what the beginning of a recovery looks like, because I think that's where we are in the office sector of commercial real estate. So some orientation to this slide. What you're looking at on the axis is millions of square feet. So the blue bars represent what we saw on average in a typical quarter in the years 2015 to through the first quarter of 2020. So before any impact of the pandemic had hit the market. And so what we saw nationally is in a typical quarter during that time frame, 15 million square feet of additional occupancy. We call it net absorption. So move-ins minus move-outs. So there were more move-ins than there were move-outs by 15 million square feet in a typical quarter on average in that 5-year period. And then if you move over to the next set of bars, that blue segment shows that there were about 10 or 11 million square feet of positive absorption in buildings that exclude medical office and owner occupancy. So in other words, you can think of those as kind of your traditional speculative multi-tenanted office buildings. So most of that 15 million, 2/3 or so of it, was in these for lease speculative buildings. You move over again, you can see that a big portion of that was what we call 3- and 4-star buildings. So you can think of that as class A below the trophy level, and then sort of down through your class B minus. I would call these investment grade buildings below the trophy level, and we use a star rating system instead of a class A, B, C as a sort of a default measure of quality. But think of these as the biggest chunk of inventory. This is probably 70% or so, and even more than that of investable real estate. So these buildings, I'll call them commodity investment grade buildings, which is maybe a little unfair, but you got a picture in your mind. So they were seeing positive absorption, occupancy gains through this period. Move to the next set of bars. So buildings that were at least 10 years old. So that's a little bit of an arbitrary cutoff point, but the idea here is we want to look at buildings once they get through their first generation of leases. So are they able to maintain or even grow their occupancy after that 10-year period? You can see 2015 through early 2020, mostly yes, they were losing a little bit of occupancy. And then finally on the right, if you look at just downtown CBD buildings, they were seeing a little bit of positive absorption, but far less, even proportionately, than their fair share of inventory compared to all buildings. So already there was a movement away from CBDs and into more sort of micro-urbanized areas and suburban areas. That's the blue bars. The red bars show the bloodbath that we've seen in the 5 years since. With all of these groups of buildings losing occupancy, and especially that 10-year-old plus, right? So these buildings were not able to maintain occupancy once the impacts of the post-pandemic workplace hit. And so they were losing tenancy, not able to backfill the space until we got to the third quarter of this year. And that's where you see the yellow bars. So the yellow bars are Q3 of this year. That looks a lot more like what we saw in 2015 through early 2020, where demand for office space turned net positive again. And even those buildings that were 10 years old and older, and this is the key, that I guess second from the right group of bars, that's the one that I'm paying probably the most attention to. What that tells us, when that goes above the axis, when absorption goes positive for these 10-year-old and older buildings, it means space that was once vacated has now started to backfill. And I think that's a key inflection point. So that's where we are. And if you want to go to the next slide, Dan, I'm going to start giving a little bit of caution to the optimism. So I do think that we've hit the inflection point. I'll talk about our forecast a little later, but I will also point to some things that are different than what we typically see in recoveries. So one is this wild variation across geographies. So the first 5 bars here are the 5 largest by square footage office markets in the country. You can see that through Q3 of this year and going back for a year. So Q4 of last year all the way through Q3 of this year. New York has 7 million square feet of positive absorption. It is far and away the national leader in the office sector's recovery. You can see a little further over to the right, Dallas, also seeing pretty strong demand growth. But then you've got DC, Chicago, LA in the middle, still losing occupancy over the last year. Interestingly, I have not called it out on this chart, but San Francisco is now turning slightly positive. So that market is beginning to recover. But it's actually, by square footage, a pretty small market, about the size of Minneapolis, believe it or not one of the 5 largest. The 2 bars furthest to the right show sort of the aggregation of the remaining top 48 markets. That's a cutoff point I use because the top 48 markets in the country all have at least 50 billion in office asset value. And so that's kind of a nice break point. And on average and in aggregate, those markets are still losing occupancy, although there's a lot of variation within them. So like, Nashville and Tampa and Charlotte, positive, San Francisco, positive, but some others like Atlanta, not quite so positive. San Diego, not quite so positive. And then on the far right, you've got all the others. So really your more tertiary kind of markets, sort of trucking along with positive demand. So the point here is that this recovery is quite geographically uneven. I think local economic factors are the big reason for that. New York does definitely also have the strongest return to office figures in the country if you look at a data source like Placer.ai, for example. So I think it's got that going for it. New York and Dallas both have financial services growth happening, which has been one of the few knowledge sectors to continue hiring over the past few months. And we'll come on to that a little more in a minute. But this geographically uneven recovery is quite unusual. Usually we see large markets flocking together a lot more than this. So if you'll move forward again, Dan, I'll show you something else that's pretty unusual. And that's just, you've heard that the supply pipeline is diminishing, and it is quite fast. So there's 2 squiggly lines on this chart. The blue line goes with the left axis, and that shows as a percent of inventory, how much office space is getting started every quarter. And you can see that it's low. So it's 0.5% and 5 basis points of inventory is how much is getting started every quarter. In square footage terms, the last year and a half, it's been something like 4.5 million square feet every quarter. I mean, that was a good couple of weeks back in 2017, right? So this is a historically low level of new construction that we are in right now, and have been for several quarters, for more than a year, almost 2 years now. And so the red line, which goes with the right axis, is pretty easy to forecast how much new space is going to be on the market in the next 3 or 4 years. And it's going below 1% of inventory. So these are buildings that are 0 to 3 years old. This is, again, a little bit of an arbitrary cut point, but the idea here is buildings that are in a stabilization period, right? They've just been delivered, and they're in the next 3 years or so, we would expect they're going to get as roughly stable as we might expect them to be. So new buildings tend to fill up, and they pull demand from older buildings. And in a healthy market, older buildings backfill that space, right? In this market, until the third quarter, they had not been backfilling that space. But what's going to happen going forward is, well, there's not going to be any more new buildings to move into. So that's going to have some implications, both for owners of buildings and certainly for occupiers as well, especially when you consider what's going on the next slide. So another complicated 2-axis slide, but I'll walk you through it. So the blue line, once again, goes with the left axis, and this is the share of all buildings that are what we call high vacancy buildings. And we define a high vacancy building as 25% vacant or higher. Why did we choose 25%? Well, once again, somewhat arbitrary, but the idea is that if you're 25% vacant and you're an investable asset, at that point, you could start to have trouble doing any more than just covering your expenses, especially if you have a loan on the building and debt service is part of your monthly commitment to cover. Doesn't mean that all buildings at 25% vacant are going to be in trouble, but it's just kind of a good, useful heuristic, I think. So back in 2015 and up through 2020 or so, what we saw was somewhere around 1 in 6, 1 in 7 buildings was a high vacancy building. You get to now, and it's more like 20%. So 1 out of 5 now. So there are more high vacancy buildings now than there were, certainly 10 years ago or even 5 years ago. The red line goes with the right axis, and that shows, okay, in these high vacancy buildings, how much of all total vacant space in the market is concentrated within them. So if you go back 10 years, about 2/3, 65% of all vacant space was concentrated in this 14-15% of high vacancy buildings. Now what we've got is over 3/4, so 78% or so of all vacant space is in the 21% of buildings that are high vacancy. So two things going on at once. There are more high vacancy buildings, and those high vacancy buildings are actually increasingly vacant. So tenants are sorting themselves into desirable buildings, and I think more importantly for the market, they are sorting themselves out of undesirable buildings, however they choose to define that. So the last thing that I'll depict here, and then we can have some discussion about the implications. So this is one reason that I think the sector, and not just office, but especially office, is facing some headwinds going forward. And it is just simply the question of, well, where do the bodies come from to fill up the office buildings that have, in many cases, lost a lot of tenancy over the past few years. So the blue line here, which is, it's kind of in the background in a few places, but the blue line here is the year-over-year change in total employment as measured by the BLS. Now, we get a BLS report as we're recording this tomorrow. As you're watching this, it might have been yesterday. It's on December the 16th. That will give us data from November and from October, which we don't have as of the time of this recording. However, I don't expect much to change in terms of the trend. So you can see if you go back 10 years, then job growth overall was trucking along at around 2%, 1.5% year over year. I've shaded the time of the sort of pandemic disruption in, massive layoffs and then massive rebound, maybe some overhiring that happened. And then for the last few years, we've seen the blue line come steadily down, normalizing to where it's been around 1.5% to 1%. You can see the forecast suggesting it's going to trend down below 1%. So more on that in a second. That's the blue line. The red line is the same metric, but instead of entire job growth, this is job growth in the traditional knowledge industries, which are professional services, financial activities, and information. So you net all those up together, it's about a fifth, 22 or 3% of total employment. You will often hear these described as office using sectors, so office using job growth. And you can see on the left side of the screen here that before the pandemic, these jobs were growing more than overall job growth. So we were adding more knowledge jobs than we were jobs overall, including hospitality and industrial and transportation, warehousing, and even something like healthcare. Since 2023, and really late 2022, I think is when the inflection point was, you can see that knowledge work job growth actually turned negative. And then over the last year, it's been essentially stagnant. So finance has been slightly positive, as I mentioned, but the tech companies have net cut jobs already over the last couple or 3 years. There've been some more headlines recently about layoffs there. And professional services hasn't moved around much. It's been positive, negative, but essentially flat for the last couple of years. So that's the red line. So job growth in the knowledge sector is actually growing or shrinking, but growing less fast than overall job growth. And then there's the yellow line. So you'll see a couple of kinks in this that I think you can sort of disregard. So the yellow line is my sort of personal estimate of, okay, well, let's look, regardless of industry, at what jobs do we expect to be done in an office environment, at least traditionally. This is a very qualitative, it's me going through a list of 900 or something occupations. I'm constantly refining this. So those kinks that you see in like 2020 and then again in the early part of this year, that's me just sort of trying to normalize it to the jobs report series from the establishment survey. But I think the trend makes sense to me, right? So before the pandemic, if you look at office using occupations, they were growing at about the same rate as overall job growth. And that makes sense because, as the economy grows, the type of jobs that get done in offices, you would expect to grow at about the same rate. Well, then, since the pandemic, job growth in these occupations has actually remained maybe a little ahead of overall job growth, but is kind of reverting to that longer term trend, right? And it has remained above, I think this is the key, it has remained above the growth rate for these knowledge sector jobs. Now, why is that important? Well, I think it's important if you think back to what we saw in secondary and tertiary office markets, where they've seen positive absorption, whereas some of the bigger markets haven't. I think that, if you think about a place like Frisco, Texas, or Nashville, Tennessee, or Birmingham, Alabama, or Raleigh, right? These are relatively high growth, smaller metro areas. And when you have a high growth, smaller metro area, what you have is a lot of just organic economic activity that happens. You have construction companies and financial advisors and doctors and lawyers and administrators of all sorts of local businesses. And there's a portion of all of those economic entities whose work is done in an office. And so what you have less of is the sort of inorganic, Amazon comes in and brings an HQ 3.5, right, to your market and creates jobs, right? So organic piece of office using occupation growth has been faster than the sort of knowledge sector, more traditional, what we think of when we think of big office using occupiers. It's been faster than that. Going forward, past that forecast line, you see that all of these are projected, and this is according to Oxford Economics, they're projected to essentially settle at about the population job growth rate, which is what you would expect long term. So I think there's a couple ways to look at this. And number one, the optimistic take would be that yellow line projects to remain, at least in the near term, above the red line. So even if there are, stalls in hiring or layoffs among some of these big ticket household name office using occupiers, that there will be enough in this more organically growing section of office using occupations to provide some boost to demand. So that would be the optimistic take. I think the pessimistic take is, well, yeah, that may be true, but all of these are as high now as they project to be for the next several years and even beyond. There might be a little bit of a temporary bump in some of the traditional knowledge sectors when we finally get through the tariff uncertainty, when we get through to the impact of the One Big Beautiful Bill Act and the fiscal stimulus there. But even so, we're looking at longer term job growth, regardless of how you slice it with these three lines here, at something around 0.5%, which is at best a third of what we saw before the pandemic. Now, not all of this is office related. Like I said, this is kind of demographic related as much as anything else, but I do think it's a headwind for the sector. So I guess we'll pause there and have some discussion about what you guys are seeing.
Fran?
Thanks, Dan. Phil, this is a lot to swallow in 20 minutes. And although we did get some advanced look at the slides, it's a lot of data and a lot of analytics, really. A couple of things that I think are interesting. There seems to be sort of a repositioning of knowledge work within the country. I mean, we see, a lot of stuff coming out of California and Illinois and other places going to Texas and Nashville and places like that, which has sort of unbalanced the markets compared to what they used to be. And that those markets were living with, very big floodplains, expecting big growth. And that's going elsewhere now because of, taxes or costs of living or something. And you described this, I think, as a fragmentation in the market, that you have some good cities, which normally would be doing very well, aren't because of these dislocations. Can you elaborate a little more on that? And do you expect that trend to continue, or do you think we're sort of leveling out as to where people want to build businesses and where they want to flee?
Yeah, that's a fantastic question. I mean, in some ways, that is the $64,000 question. And I'll set up my answer by saying there's two things that I didn't even mention yet that I think are important. I did not mention remote work, hybrid work, return to office, right?
Right.
And I did not mention AI.
Right.
Both of those are continuing. The return to office story has a long tail, so it will continue to have an impact of some sort. We can talk more in a minute about sort of where we think things are going there. And then, of course, AI and the types of jobs that it could potentially threaten or create. And I think that's relevant to the geographic discussion. So, for example, if you think about a market like New York or a market like San Francisco, so gateway market, an investable market by important sources of capital from all over the world, right? Also an expensive market in which to live. I was speaking with a very well-known New York office broker a couple of weeks ago, and we were talking about, well, what does AI mean for a market like New York? And she said, well, one way to think about this is that companies don't pay workers to work in Manhattan to do the kind of work that they expect they're going to get AI to do, right? So in other words, they're bringing in people for purposes of very high level thought work, very high level collaboration work, which I think is part of the return to office story in New York. The type of work that they expect may be more susceptible to automation and AI. Well, those aren't necessarily the kinds of jobs that you would expect to be done in a Midtown Manhattan office or in a South of Market in San Francisco office. So that's one way to think about it, right? There is a geographic way of sorting different types of knowledge work. I think the other dimension of this is, of course, yes, there is a public sector aspect of this in terms of local policy and tax in order to, attract companies who end up being occupiers to the market with tax incentives and that sort of thing. And then there's just the cost of living aspect, right? So there's a reason that people move to Dallas. And there's a reason that people, I think Austin actually got pretty expensive until apartment rents peaked there a year or so ago. But for a while, there was a reason people moved to Austin, Texas. And the same is true of Florida and Tennessee and North Carolina, et cetera. So all of these dynamics are interacting. And I do think it's important. There was a study done a year or two ago that, and I can't remember the source, but I talked with our market analyst in Raleigh, and the study ranked the Raleigh-Durham area as one of the most friendly for remote knowledge workers. So if you were someone who had a full-time remote job or a job that you could do remotely, that Raleigh was a really attractive place to be based on, the concentration of amenities and the cost of living there and all sorts of things. So I think all of these things matter, and they're going to play as sort of local market factors when you think of it in terms of office demand. And then you have to throw in the other piece of this, which is like the office economics, right? Because it costs maybe a little less to build a building in Raleigh than it does to build one in Chicago on a per square foot basis. But that difference is probably not as great as the difference in rents you could achieve, right? So if you put a building, a brand new office building in Fulton Market in Chicago, you're looking at rents that are 3 times what you're going to get in downtown Raleigh or in maybe suburban Charlotte. So that's part of the calculus as well. Is there are different kinds of supply constraints that matter to the office sector as well.
Okay, a 2-part follow-up, because I know we need to move on here. New York is really an outlier in many ways, and it is America's city, and it does a lot of things that no other city does. So it's a bit, and it's not a good example for what's going to happen elsewhere necessarily. But if you just look at New York, I would agree that you're getting higher levels of people who are being brought in with the higher level activities that all these major companies are in, and those are the people that they want to bring to New York. But what happens to the native population? They're not moving anywhere. They're going to be there, and they're now working under the Mandami regime. That sounds bad, doesn't it? There'll be a new mayor with a different orientation about what to do with people that actually live in the community, and how are they going to be employed. So that's more of maybe a sociology question than a real estate question. But the other thing about a big market like New York and Chicago and some others, about 2 years ago, when we looked at the amount of square footage that was leased prior to the pandemic, but which had a tail in terms of its renewal or when it was going to roll over. It ran out to like 2031. I'm sure you remember that. And it was roughly 200 million, maybe a little less a year from wherever we talked about it through 2031. What are you seeing in that segment of the market? What's happening to those spaces that are in New York and Chicago? But what's happening to those spaces? And do you see that as an indicator of what we may see? And is that built into your trends that you're showing? Let's leave it at that.
Yeah, I mean, it is. It is and it isn't. So I think certainly the differences in expected economic and population growth, our forecast handles those at a local level. And I take the question in that direction because the answer to what's happening with that roughly 1/3 of space leased before the pandemic that has not yet faced a lease expiration. The answer to what's happening to that space really does differ. So in New York, I think in aggregate, that space has probably been adjusted as much as it's going to be. There may be one-off examples of a company that says we're going to trim our footprint, but that's going to be counterbalanced by companies that are growing in the market. A place like San Diego or Atlanta, I'm not sure that's the case. I think there is still some risk in places like that of companies that, they aren't really growing very fast right now. They come to the end of that lease next year after that, 2029, and they think, you know what, we don't need this extra floor anymore. We never bothered to put it on the sublet market, but we're just going to consolidate. And I don't know that some of those markets will have the surfeit of demand to backfill that space. Some of them will, and some of the nicer buildings. And so again, we have this variability geographically, right, in terms of how that's going to play out. Then of course there's the impact of supply, right? So if a company has been in a space for a couple of lease cycles, that tends to be when larger occupiers move, is after a couple of lease cycles. But if there's nothing new to move into, what do? I mean, that they may just stick around, and I think we're already seeing some of that behavior. Dallas still has some new supply in the market. Miami and Seattle still have a little. Boston has more than it needs. But not everywhere does, right? So already in New York or in certain parts of Chicago or even LA and the high performing submarkets of those cities, you already see this constraint where there's just nowhere to move into. And so that gums up the whole market.
Okay.
You had a second part to that, Fran?
No. I think I think you hit both of them, Phil.
Cool.
Thank you.
Mark?
Phil, you've said and you've written recently that the pandemic taught occupiers that they can be far more flexible and precise with their portfolio decisions, that they don't need to make long-term commitments for growth space, for example. But the supply side is still largely built around long-term fixed leases. Is this an inflection point for co-working and flexible office?
In some ways, it probably should be. The question of whether it is different because economic actors don't actually always perform perfectly rationally. And I think the one thing that makes it hard to answer that question is the fact that we have such low job growth overall now. In an environment where supply growth has really slowed down, but underlying demand growth is still advancing. Well, then I think it's all right. Let's put our money where our mouth is, right? Do we just keep bidding up the price of whatever vacant space we can find on a long-term lease basis, which frankly we're not seeing. But we're not seeing that because we don't have the growth, right? Or do we fill in the gaps with flex work? And I think there are certainly examples of that. And you can just look at all the landlords, the BXPs and Vornados of the world that are rolling out and have rolled out their own essentially flex work products within their buildings. And you look at CBRE buying Industrious, Newmark and Notel, I believe. So there is some resonance there on the supply side with big real estate players seeing it as an opportunity. I mean, it certainly makes sense. I think the challenge continues to be, how do you underwrite the return on that space? Not that it doesn't have a powerful logic to it, but how can we build a predictable and relatively low risk projected income stream out of that, right? So if you are a Tishman or a BXP, then you're handling that calculus yourself. But if you're a lender on a speculative office building and you're looking at a borrower who wants to put a flexwork provider in on a lease is one thing, but even on something like a long-term management agreement, profit sharing agreement, well, they just got to do some different mental math right now. And I don't know that, I'm not saying that can't be done, but when lenders are still struggling to sort of deal with a portfolio that has some hair on it right now, in the office sector, I think it's math that maybe many of them don't want to do. So I think the jury is still out on that question. I mean, it certainly has a powerful logic to it. There are many examples of companies making some use of it. The WeWorks deals with Amazon, for example, I think are interesting examples of that. But as for whether that becomes, a long-term solution, I think the jury's still out. We'll see what happens if and when demand really does catch up, or at least it's steady enough and supply stays low enough for long enough for things to get really tight.
You cite the examples of Tishman and Boston Properties and Hines here in North America, all of whom have taken the leap into in-house flexible office brands, backed and developed by the asset owner. I just came back a few weeks ago from attending the Co-working Europe conference in Berlin. And this is anecdotal, but it was conspicuous how prolific, how many landlord-backed operators, and not just giant players such as a Boston Properties or a Hines, but dominant local players, asset owners, focused on Amsterdam or on Warsaw. It was conspicuous how many examples there were of landlord-backed flexible office plays, and landlords that looked holistically at the whole leasing stack of their asset and saw the place for flexible office, both co-working as well as managed office and spec suites. Do you think that perhaps greater maturity in Europe around this particular approach is going to be motivational to the investors and owners here in North America, motivational to get them to do the math you were describing just moments ago?
It could be. I mean, I think two of the really important considerations here are, number one, scale. Mm-hmm. So the nice thing about a landlord provided offering is that they're going to self-scale it in a way that is going to make sense and be accretive to them. And I think that dovetails with, and I keep coming back to this, but like your organically growing demand. So I was speaking with our San Francisco market analyst a week or two ago, and I mentioned that San Francisco has actually started to recover. But part of that recovery is leasing by venture-backed AI and other tech companies. Yeah. And when venture-backed companies take on space, I mean, they do it in a way that ultimately resulted in what we've seen in San Francisco the last few years, is they take the space well in advance of when they actually hire the people to fill it. And that actually made me a little queasy when I was talking to him. I was like, oh, here we go again. Whereas if you have a more organically growing source of demand, then I think with properly scaled options for workplace real estate, right, including flex work, including landlord provided spaces within their buildings, to me, it makes that math easier, right? I don't know what happens if you've leased 2 floors to an AI startup that then gets bought or goes belly up in 6 months. I mean, I think we do know what happens is it ends up on the sublease market, which is where a lot of it has been for the last 3 or 4 years anyway, right?
And we also know that those VCs that are putting billions of dollars behind those AI startups in San Francisco and in some other markets, we also know that they aren't asking for 10-year profitability roadmaps of those companies. They're looking for blitz scaling on 2.
That's
3,
right.
4,
They're
5 years.
hoping that the next Meta, the next Alphabet, the next Microsoft, right, and one or more of them is likely to become that, right?
And they're banking on the fact that 7 out of the 10 investments that they make are not going to survive as companies. That one will be a 10x return, and 2 or 3 might be a 3 to 5x return. And so, by that math, 70% of those office leases that are driving the San Francisco absorption are at least by the point of view of the VCs behind those firms, 7 of those 10 leases are going to go bankrupt.
The problem with expected value is that, of course, is impossible, right? You never get 70%. You get either 100 or 0, and it's just you get sort of who gets left holding the bag.
Guys, we're running a little short on time here. I'm going to go to Fran, I think, for one question, and then finish up with Mark. So, Fran?
Okay, well, I had a good follow-up there, but I'm not going to ask it. I'll have to save that for next year. On the subject of AI, and I think we do need to talk about this a little bit today. Most of the impact of AI is not yet in your numbers, I don't think, Phil, and maybe you have made some accommodation there. But everybody involved in AI, everybody involved in the country, I think, believes there's some sort of bubble. Whether it's a small bubble or a big bubble, there's something that has to pop somewhere to sort of move forward. And I'm just curious, in terms of your forecasting, Phil, how have you dealt with this whole issue of AI and the impact? And I know we talked once about a range of impact, that it could be quite small or it could be very large. It really depends on whether we have another .com situation with AI. And we won't know that for a little bit. What's your take on AI's impact on the market next year?
Yeah, so the approach that we take is that we very bravely defer to our economics data provider, which is Oxford Economics. And I'll tell you what's kind of baked into the numbers as far as our forecast goes. They did a study a year and a half or so ago in which they also looked at occupations. So they looked at data at this very granular level. And I said, okay, well, what's the potential risk to each of these occupations for disruption by AI? And of course, the overwhelming majority of occupations they found at risk turned out to be what we think of as office using jobs. And so what they came up with numerically in the aggregate was they estimated around 9% of all jobs in the economy, again, disproportionately office using jobs, could be disrupted. And this is over a period of the next, I think, 7 years. But they thought that only about 20% of that 9%, so call it, 1.8% or so, would be permanently disrupted, and the rest would be sort of temporarily disrupted, and ultimately those people would be able to find their way back into employment. So that's not a very big impact. 1.8% over 7 years is a little bit of a drag on employment, and that is baked into the forecast. I think more qualitatively, from an adoption standpoint, it's your tech companies and maybe some of your big banks that are on the more cutting edge of using the technology. Anecdotally, what I have heard, and you can take this with a pinch of salt, I have heard that this means that companies have been able to either reduce more junior staff or avoid hiring them in terms of, you think of your software product type jobs in a tech company. And that's had some interesting effects. So one, it has kept their payrolls down. Two, it could be that the AI use is making them more productive. But three, it's actually freeing up their more senior people to focus on individual productivity. So they don't have as many more junior people to mentor, which kind of makes them more productive, at least in the short run. So you can debate what the long-term downstream impacts of this would be. But I think we actually are seeing some impact among these high adoption companies. But I think to your point, Fran, is most companies are not really high adoption companies yet of using the tech. And I think a lot of tech workers have managed to find jobs in other sectors, whether that's banks or law firms or insurance agencies or whatever. Long term, like I'm a tech optimist. I think technology ultimately results in more work for humans to do. Short and medium term, when we had cotton gins and tractors, there are a lot fewer people are working in fields now. Now, ultimately, there were more humans doing work, but they're not doing work in fields. And so that could happen in office, or it could be that there's a whole universe of office-oriented jobs that we haven't really conceived of yet that will result from these technologies, but we just don't know yet. It could be that those jobs have nothing to do with working at a desk.
My brother works with soybean farmers. All those farmers are behind big screens at their John Deere tractors. So they're not in the field, they're behind the screen. Mark finishes up.
Phil, if they don't, nobody knows. and we've been glass half full, and I'm a perpetually glass half full guy, but let me be glass half empty, or even just neutral. If they don't result in more jobs, and if everyone that is taking space continues to want the best space, as your slides showed, what happens to everybody else? What happens to everybody else that owns buildings or invests in buildings? Your data was pretty clear about the where the recovery is happening more clearly. And it's in the 3 and 4 star buildings, it's in the trophy assets, and it's in spotty select markets. A year or two ago when you joined us, you talked about the magnitude of the overhang still. What happens to everybody else that owns buildings?
Well, I think the answer to your question is this is a matter of degree and not kind, right? So what's going to happen is what's going to happen anyway, which is like the example I use is look at Dallas. Dallas has structurally some of the highest vacancy rates in the country and has since before the pandemic, because in the 80s and 90s, it was just really easy to build there. And so they built a lot. And so the result of that is that the real estate market and investors and occupiers and owners and lenders, like there's maybe some adjustment, but they end up fine, right? They're more easily able to scale their involvement. Even think about all the way up to the pension fund level. They can adjust their allocations to real estate and to the office sector in particular. And so you can have this perfectly functioning, finely functioning market with rising rents and everything, with people concentrating in the best space. And then the answer is, well, how big of an urban planning problem do you have with empty buildings? It doesn't ultimately become a real estate problem per se. I mean, it is in one sense. We built these physical assets, but it's really more of like an urban management and municipal kind of issue. And I think the answer to your question is, it's just how big is that issue and how broad is it? And I think that's probably where you're going. And I think the optimistic answer is, regardless of how big it is, we figure out a way to repurpose space and make it more flexible and more usable for a variety of things that humans like to do indoors, right? And I think we'll get there eventually, but the scale of the problem determines how long.
A hopeful note to end. Gentlemen, this has been great. Phil, you taught us another masterclass. We are in your debt, sir. Before we get to the final question, I'm hoping you could point our viewers and listeners to where they can find you on social media to learn more about you and perhaps have a conversation.
Sure. I am most active these days on LinkedIn. So you can just search Phil Mobley. I think it's actually Phil-Mobley now is my profile, but search for me and you'll find me. And you can also find me on CoStar.com. I'm a frequent author of articles for our news site and write analytical reports there as well.
So let's get to our final question, which we ask all our guests, which is, what's your work fit? So Phil, what attribute, condition, experience, place, or state of mind makes the work that you do a wonderful part of your day, doing many other wonderful and meaningful things, and not the all-consuming time suck of a day? What's your work fit?
Well, I think you've said my answer in your question, which is a part of the day, right? And so I think I'm a person with a fairly long commute.
Yeah.
But I have learned how to make the best of that commute, and I have learned to enjoy the discipline that comes with, okay, there's stuff I got to do before I get on the train, right? If I'm going to work out, it's going to be first thing in the morning, right? I'm going to get my cup of coffee. I'm going to shower. I'm going to get on the train. I'm going to use that time for spiritual and mental reflection. I'm going to use that time to listen to my sports podcasts and, my history podcasts and my business podcasts. Then I'm going to get to the office and I'm going to hit it hard. And then I'm going to go back to the train and do the same thing on the way home. And by the time I get home, I'm going to be ready to step into the house and be a dad to the 4 kids and help clean up the dishes and sit and read a book or watch a movie. And so I think having that commute provides the end points to that discipline that I think I've learned to adapt pretty well to.
We know we're going to have you back in 2026 because this story is ever evolving. Phil Mobley, thank you so much. Fran and Mark, my buddies, my partners, thank you so much for a great season. Hey, everyone, we'll see you again in 2026. Have a great holiday season.
Happy
Take care.
holiday. Bye.